How's it, guys? Welcome back to another video. Today's video is about a 5-step process to identifying A+Entry setups using ICT concept. So we're going to use ICT concept to identify high probability A+Entry setup. So please hit that subscribe button, like this video, and share this video with your friends and family. Now let's get to the video. Okay guys, let's go to step number 1 of our 5-step process of identifying A+Entry setups. The first thing that you need to do is know what session that you are trading into. There are three trading sessions that are going on around the world, which is a London session, the Asian session, and the New York session. Know which session that you are trading. I personally trade the New York session, and in that New York session I only trade the AM session. So from 8:30 in the morning all up until 1 o'clock noon in the afternoon, the early hours of the afternoon. So I only trade the AM session, right? So that is step number 1. Step number 1 is identify your trading session, and in that trading session, identify your kill zone. So let's go to step number 2. Step number 2 is identify the nearest liquidity. What do I mean by the nearest liquidity? Because I'm trading the New York session here, I have to go to the left and look at the first swing high or swing low that I personally see. That will be my draw on liquidity, which will be my buy side and sell side liquidity respectively. So let's look at for our buy side and our sell side liquidity. So this is the first high that we see. So this becomes our buy side liquidity. This is our buy side liquidity. So now we're going to look for the sell side liquidity. You look for the first low that you see prior to 8:30 in the morning, which is this one. So this becomes your sell side liquidity. Okay, now that you have your buy side liquidity and your sell side liquidity, and if you're wondering this is a high, why are we not using this high? Because this high was already run before the market opened up at 8:30 in the morning New York time, right? So we cannot use this high because it was already taken. So the first high which was not taken was this one, and the first low which was not taken was this one. You can include as many lows as you want as your draw on liquidity. Why am I including this as a draw on liquidity? You will see when I continue with the video. So now step number 1, identify your trading session. Step number 2, identify your nearest liquidity. Now let's go to number 3. Number 3 is wait for a liquidity sweep and a reaction to a higher time frame PDRA. What do I mean by that? You wait for either the sell side liquidity to be rated or the buy side liquidity to be rated. Whichever one is rated first, you take trades in the opposite direction. So now here we see that the buy side liquidity has been rated. If the buy side liquidity has been rated, then we go to a smaller time frame and look for our market structure shift. Let's go to the smaller time frame and look for market structure shift. I usually use the 5 minutes and the 1 minute time frame, but let's go straight to the 1 minute time frame and look for our market structure shift. Okay guys, now we're on the 1 minute. I usually use the 1 minute or the 5 minutes for entry, but now I went straight to the 5 minutes because I don't want to make the video unnecessarily long. So now we have gone through some of the stages. Let me recap. The first step is identify your trading session, which is the New York session from 8:30 to 1 noon. So I'm only trading the AM session. Step number 2 is identify the most recent liquidity. The first swing high before 8:30 and the first swing low before 8:30. Number 3 is wait for either the buy side liquidity or the sell side liquidity to be rated. Whichever one get rated, you go to the smallest time frame or the time frame that you use for entries and look for entries there, right? So now we're on the 1 minute time frame. We're going to look for our market structure shift that will confirm our buyers to take the right trade in the opposite direction, because buy side liquidity has been taken. Now we expect the market to attack the sell side liquidity, so that means we expect to sell. So now we're looking for liquidity, not liquidity, a market structure shift to the downside so that we can take entry. So in respect here, we see this high and we see this high being taken here, and when this high was taken here, we see the market making this high and the market making this low and the market failing to make a higher high, showing us that it's unwilling to go up, so it wants to go down. So we see a break of structure to the downside here. We see a break of structure to the downside, and you can look at this leg from this high to this low and say, now we can look for your entries here. But you cannot look for entries here. Why? Because you remember, we buy in a discounted market and we sell in a premium market. So let's look at our discount and premium. So the only place that we would have been able to sell to is here, but we cannot sell from a PD array that is in a discounted market, because we are selling, we need the market to be in a premium so that we can sell. So this leg automatically disqualifies as a place where we can take our sell. So now we have the market making this high here, and we expect the market to come and take this high. So the market cannot go up, cannot go down and attack the sell, the 50 minutes sell side liquidity without taking this high. We have the market making this high, and we have the market again making this low again by breaking structure to the downside. This is a fake out, guys. This is a fake out. When you see this structure and you see this fair value gap here, you say, okay, I've identified the 2020 YouTube model, so I can sell from here. So, but you do not sell from here because you're expecting the market to come and trade this liquidity from the buy side again, because the market cannot leave this liquidity and attack the sell side liquidity, because it's going to be a long-term sell if the market decides to go down, and then it cannot change the from buy program to sell program without taking this up buy side liquidity. So we expect this liquidity to be taken before going up. So let's drag this out. Similar thing that is happening here. The market makes equal highs, comes and breaks structure to the downside. We do not sell until we see the market going above this high. So we have this is our equal high. So we know that there are a ton of liquidity that is resting above this high here. We have a ton of liquidity up that is resting above this high here. So we're waiting for the market to come. So when this time comes here, we see the market going above this high here. So now, because the market went above this high, we can expect the market to attack the sell side liquidity now. So now we have to identify our ICT concept that we are going to use in conjunction to form our A+Entry setup that we're going to sell from and target lower. So the first thing that you're going to have is you have this order block here. It's an order block because this is the last up candle before this liquidity was taken here. So this becomes your order block. That becomes your first PD area that you can sell from. But now, because we need more, we need confirmation. We have our fair value gap here, and we have our inversion fair value gap here, and we have our breaker block here. We have our breaker block. Okay, this is our breaker block. Then we have our volume imbalance. If you don't know what this concept are, go to my channel and look at everything that is here. Everything that is here, I've discussed it in detail. So now that we have all this concept, now we have the most important thing that we have to discuss: discount and premium. Is the market in a premium so that we can sell? Let's take out our FIP and plot it out here from this high to this low, and we have our discount and premium here. So we have our equilibrium here, so we're safe to sell. So now where can we take our entry? We're going to use multiple ICT concept to take our short position here. You can use at the 50% of this breaker block, which is in conjunction with the fair value gap, the inversion fair value gap, the order block, and the volume imbalance. You hide your stop loss above this fair value gap here, and you target the 15 minutes sell side liquidity, which is here. So your trade is going to be something like this. You either sell at the 50% of this. So let me mark this breaker block perfectly. So this is the breaker block, and the 50%, that means the 50% has to go up to here. 50% goes up to here. Yeah, the 50% goes up to here. So you have your breaker block, you have your volume imbalance, you have your order block, and you have your discount and premium market, and you have your market in a premium market, which is ripe for you to sell. Further up, we have our inversion fair value gap, which the market didn't go up to, and we have the fair value gap, which the market didn't go up to. So in essence, we have the 2022 model, we have the fair value gap model, we have the inversion fair value gap model, we have the volume imbalance model, we have the breaker block model, we have the order block model, and we have the volume imbalance model, which are working together to confirm our buyers that the market is now going to attack liquidity. So, but in order for you to manage your trade perfectly, you can first go to this low here, go to this low here. So anything below this low is going to be your first partial. So you're going to take your first partials when the market comes here. You're going to take your first another partials when the market comes to this low here. When the market comes to this low here, you take further partials and you move your stop loss just above this high here. So now when your stop loss is above this high, you know that your trade is secure, is running risk free in some sense, because if the trade stop you out, you already took your partial and it stops you out in profit. So you keep on running your trade like that. So another partials is going to be here at this high here, sorry, low. This is going to be further partials. When the market comes here, you take partials and you move your stop loss above this high here. You move your stop loss above this high here, and the market will be here. So your position is going to be something like this. You keep on scaling the lows. We have another low here, we have another low here. So you get the point. So whenever the market is at this low here, when the market is at this low, you put your stop loss above this high, because it's even greater, because you already took out people who sold late. So this is an inducement. When the market is here, you put your stop loss above this high. So the market takes out this high, takes out this low, and takes out the sell side liquidity, and you're expecting the market to go to this extremely low which is unfortunately for you, because if you're expecting this price, the market is going to kick you out above this high here, because your stop loss will be somewhere here and you'll be stopped out by this candle. Okay, that's all I have for you today, guys. So only in a recap, a 5-step process on how to identify high probability A plus trading setup is you have to know your trading session, right? Back test as many concepts in your trading session as you possibly can. I usually trade the New York session and the AM session in that New York session. So number 2, identify the nearest liquidity point prior to 8:30 in the morning, prior to the stock market opening. You have to look for your first low and your first high, and it becomes your buy side and sell side liquidity respectively. The third step, you wait for a liquidity sweep. Either the buy side liquidity is swept or the sell side liquidity is swept. So you can see by me juggling between which one is getting swept first, I'm not usually looking for a higher time frame buyers. So I'm relying on the 50-minute time frame only. So step number 4, after that liquidity sweep, wait for a displacement in a direction that you are looking to take your trade in. Right? If the buy side liquidity is taken first, you have to take the trade in the opposite direction. That means you have to look for sell. If the sell side liquidity has been taken, that means you have to buy. So step number 5, which is the last one, is look for as many ICT, PDRA, and entry model that you can use as confluence to take your entries, base and pyramid. What I mean by base and pyramid is you can take your first entry, and as soon as you see another entry, you add another. You see another entry model, you add another entry. Another entry model, add another entry. You pyramid your entries like that. Okay, guys. So if you haven't subscribed so far, please subscribe, like, share, comment. I need to get at least 300 likes and 300 subscribers from this video. Till we meet again. Peace out.